I'm Joanna Simpson here at Risk Minds International in London. Joining me now is Katherine Wolicki, Global Head of Financial and Model Risk Regulatory Policy and Engagement at HSBC. Thank you for joining me.
No problem. Thanks for having me.
And just tell me a bit about the upcoming regional Basel regulations.
It's a huge package of reforms. It's effectively looking out across all of the previous banking book, trading book frameworks we had in place. Operational risk is also kind of captured in a part of that. So it's looking out and doing a pretty major rehaul of all of that. So we're looking at changing everything we do on the internal modeled side for market risk through FRTB. We're looking at changing what we can model on the banking book side for IRB. On the standardized side, we're changing some of the risk weights, some of the bucketing, introducing input floors for certain exposure classes, output floor to kind of limit the benefit that firms get from using an internally modeled approach. So there's really a lot of change that's happening. And I guess, maybe it would make sense to think about the driver for that. Post-crisis, obviously, there was a huge focus on regulation. The initial wave was looking at increasing the quantum of capital, the quality of capital, introducing things like liquidity requirements, LCR, NSFR, and then a leverage ratio as a backstop. This is sort of the flip side of that. So looking at the denominator to the way we calculate risk in a bank and kind of making sure that we have fully addressed any concerns we have there, namely variability. Because as regulators themselves have said, when they were looking at the way firms modeled these risks, there's a lot of variance, there's a huge range. So that didn't make people feel particularly comfortable. And indeed, in theory at least, you would expect to have at least a kind of broadly similar range of capital for the same sort of exposure. So that's kind of the background, a little bit about it. To answer your question.
And how much divergence do you expect to see across regions?
I think we have to wait and see because we're still in the midst. We've got the US, which is what everybody's talking about today. They're in the midst of finalizing their NPR. They're consulting on it now. The consultation period has been pushed back until mid-January. So that's a very important jurisdiction in terms of financial markets, figuring out where they're going to land. So that's a little bit of a question mark. The other jurisdictions, we have a pretty good idea where they're going to come out. So we've been talking about these reforms. 2017, the framework was finalized at the Basel Committee level. We've been talking about this for quite a long time. So I think we do have a pretty good sense of where the rules are going to land. But there's always some kind of small things that creep through. So, a couple of examples. The US has gone they've taken a very conservative approach. They've removed internal models for credit risk, IRB, for counterparty credit risk, IMM. They've retained it for market risk. And actually, interestingly, we're seeing a lot of areas where there's more flexibility to what we have seen for the UK and the EU, which is, things that, so it's just a bit interesting there. And I think that has the capacity to kind of change some of the flows we're going to see from markets perspectives. And then at a more granular level, I guess there's also some divergence and some change that we're probably going to expect to see a CVA. So we're seeing the PRA and the UK now capitalized for CVA, which wasn't the case before. The EU is still allowing CVA to be exempt for non-financial corporates and kind of end users in that capacity. So there's a bit of divergence there. And then things, sovereign risk weights. So the PRA has done away with modeling for sovereigns. We're seeing some movement on the market risk side for how much capital we need to hold for them in the DRC, the default risk charge. So those are a couple of examples. So high level alignment, but still some pockets of divergence and actually some big question marks, I'd say, in particular for the US and where they're going to come out on that.
So what should risk managers be considering in this era of fragmentation?
So I think the first thing would be thinking about what does risk management look like now? Because we are doing such a huge overhaul of the framework. It's really, really soup to nuts. So I tend to focus a lot and think a lot about trading book side of things, so I'll kind of give an example there. And I was speaking about this in a panel earlier. We're going to be in a world where we've got standardized charges and advanced charges, and we need to look at both of those simultaneously. And then we have the capital floor that could potentially be binding at the top of the bank, and then the extent to which that's going to be kind of cascaded down to desk level or to product line. So from an MRM perspective, market risk management, if we're talking about in the trading book, there's going to be an added degree of complexity to think about those different metrics. What does that mean for my book? What does that mean for the specific product that I'm trying to trade? And then how do I make sure that I'm holding accurate capital for that, but also how am I able to make money? How am I able to manage my risks? So all of these kind of fundamental questions. Banking book is going to be similar. So we have to think about the standardized charge and the advanced charge where we can still hold internal models. And I think that going forward, we're going to see clearly there's a move away from internal models towards standardized approach, more kind of uniform reflection of that risk. But in so doing, what are we missing? Are there certain second order risks, certain pockets of risk that are just not possible to capture under these kind of more blunt tools, under these non-modeled approaches? So then the question has to be, well, what are my other tools? What other things am I going to look at to manage that risk? And so, stress testing is an obvious one. The extent to which we've got stress testing, BAU stress testing, ad hoc kind of idiosyncratic scenarios, reverse stress testing. Do I have the right library of stress tests? How am I integrating those into my limits? I don't want to have a lot of noise. I don't want every single stress test to result in cutting a limit here or there, but getting that balance right. So that's just one example of a tool that we'd probably expect to be seen more. But I guess more complexity, and probably in moving away from internal models, the need to really think about this outside the box and kind of not just, well, what does the model tell me? But no, what is myself as a risk manager, based on my years of experience, what do I need to be doing? What are the questions I need to be asking? How do I need to be proactively considering that? So those are a couple of things to answer that.
And many regulations have been brought into effect over the last 15 years. What have you learned about riding these waves?
It all goes in circles. It all kind of goes, it's cyclical, right? So you kind of, this was before my time, but the initial Basel reforms, I think 1988 Basel Accord, we were moving from a standardized approach where we wanted to move towards internal models to have more risk sensitivity, make sure that we had more diversification, not too much concentration of risk, and now we're moving back the other way. So these things do kind of go in cycles, and I guess you just have to kind of ride the wave and know that it's sort of like the arc of history is long and we're going to probably repeat ourselves at some point. So I guess that's one takeaway. I think the other thing to think about is, and one consistent point is the dialogue we have between supervisors, between policymakers, and between firms. I think that has improved over time, and that's obviously a really positive thing. It's incredibly important to make sure that we're running empirical analyses on the impact of these reforms, that the results of those are being considered by supervisors, by firms alike, and that that's being fed in and considered in the right way. So having that right communication channel, the cooperation, the dialogue, really important, and that's definitely a constant as we kind of move over time. And I guess the thing, being vigilant, and kind of the point I was making about risk management, nobody has a crystal ball. Nobody knows where the next risk is going to come from. If we did, then we would probably be out of jobs. So it's more art rather than science, and it's that requirement, that need to really be thinking outside the box, to be agile, to be nimble, and to be asking the right questions when the time comes, and probably to be quite courageous about asking the hard questions, quite courageous about stepping up and saying, actually, do you know what, there's something that's not right here. Because when you don't, that's when you get into trouble. So,
Katherine Wolicki, thank you very much for your time.
Thank you.